Hey guys, my name is Jack and I'm sure you've seen the news already, but the Australian property market is in full-blown FOMO boom mode. Oh, try saying that 5 times quickly. In less than a year, we've gone from warnings about a 30 to 50% drop in property value across every city in Australia to every single media source now talking about a 5 to 20% increase in price over the next 2 years. Of course, the government helped out in providing the JobKeeper and JobSeeker scheme, and financial institutions also provided a helping hand with mortgage holidays to protect this supposed tsunami of properties that were going to flood this market. These were financial experts, head of banks, economists. One of them went as far as outlining exactly what the worst case scenario would be for us to have this 30% drop in property prices, of a 6-month lockdown, economic collapse and business collapse, a spike in unemployment. That is exactly what we had in Melbourne. We had a second wave, we had the 8-month lockdown from March 2020 to the restrictions being fully lifted in November. During that whole period, the real estate market fell a very slight percentage based on the property that were being listed, but the median house prices increased by 4% in the latest quarter. So the question is, what the hell is going on with the property market? Are we in a bubble? Is this going to be our new norm? Or is this just another sign that the whole world is broken? Now, I previously made a video saying that the first 6 months of 2021 is going to be the best opportunity for first home buyers to try and sneak into the market, but everything has moved so much faster. All of this can be down to one thing, and it is the low interest rate environment that we're currently in. Super low interest rates mean that cheap money is being flooded to the market and loans are being given out to anyone that has been able to buy a $20 t-shirt without having to use Afterpay or a credit card. First home buyers are out in droves, and every property inspection looks like the beginner slopes at Mount Buller, where there's just arms flailing, limbs breaking, and there's queues to every chairlift. To understand housing, we need to look at the whole supply chain and how the latest economic developments have affected developers, builders, and purchasers. Now, developers can range from mum and dad building a townhouse or a unit in the back of their existing property, right through to the big boys doing $500 million, $1 billion towers and land developments. But regardless of size, every developer has two main costs that they need to consider when looking at feasibilities or whether or not a project is financially viable. And that is the acquisition cost to purchase and hold the land, and the construction cost of actually building the project. Low interest rates mean that the borrowing cost of purchasing the land and building the actual project have been significantly discounted for the developer, meaning projects that previously didn't seem viable are now worth a second look. To understand some rough numbers, the interest rate on development lending is typically a little bit higher, and in 2018 was sitting around about 6%, whereas currently in 2021 you could get a loan for anywhere between 3 to 3.5, meaning that previously a $5 million project, you can save $175,000 on borrowing costs, interest payments alone. So suddenly, projects that previously didn't seem viable are now options for these developers to look into. Secondly, let's talk about the builders. On the back of industry shutdowns, labor cuts, staff cuts, and a decrease in importation, we actually are going through a material supply shortage at the moment in Australia. This has resulted in an increase in price across both timber and steel, which unfortunately makes up for almost every single component of a standard construction project. Steel prices are currently at record highs, and timber has increased anywhere between 6% to 10% depending on the supplier. That, with the increase in demand, with developers undertaking more projects because of the low interest rates, a lot of builders are running around trying to find subcontractors that are free to do the work. And subcontractors in turn are increasing their prices to make every project worth their while. So overall, the construction cost has increased because of the lack of materials and the increase in price, the lack of good subcontractors and the increase in their price, and the lack of good builders and the increase of their price. All of this trickles down to the end purchaser, who has been given the green light to spend much more money than what they possibly could have previously, now that we've scrapped responsible lending laws as well as with the record low interest rates. So just to give you an idea, a single person with no debt, no dependents, earning $100,000 a year could previously get a loan of about $650,000 at 4%, can now get a loan of $770,000 at 1.99%. Now, assuming that they have a 20% deposit put away, then that translates, assuming they have a 20% deposit put away, that translates over to a purchase price of $813,000. This translates over to a purchase price of $813,000 at 4%, now to a purchase price of $963,000 at 1.99%. One other thing to note is that the loan at 1.99% for $700,000 actually has less repayments than the $650,000 loan at 4%, which is just crazy. If the interest rate remains low and there is a low supply of stock as well as a high demand of buyers, then the trend for the property market is going to continue to go upwards. But instead of looking at it as house prices increasing, it's really money decreasing because it is so cheap to borrow at. With median house prices in Melbourne sitting between 12 and 15% of the median salary. As depressing as it may seem, it looks like it's going to remain that way for at least a couple of years. The positive from all of this is we've got examples as to what to do in a really low interest rate environment to not only keep up with inflation, but maximize your gains and protect any downside. One of the main players that we haven't really talked about are the banks and financial institutions who are lending this money. With the super low interest rates, profitability on loans aren't what they used to be, and typically financial institutions will start looking at different avenues to make some spare cash from all the money that they have sitting in their sock drawer. This usually comes in the form of either investing in the stock market, in real estate, government and treasury bonds, and now some of them even going into crypto. The low interest rates create an environment for temporary inflation, so to protect yourselves from going broke, when avocado toast goes from $23 to $30, there is a few things you can do. Now, as it goes, this is where I have to put a disclaimer to say that I'm not a professional financial guru. I am just a finance enthusiast sitting on a couch putting videos on YouTube. So don't take this as professional advice, and please consult a professional if you need to. The number one thing you can do is you can invest in the share market and into ETFs. A good market index ETF will be able to capture all of the inflation and outpace it by a couple of percentage points. All the important companies have really smart people working for them that are continuously working to increase revenue and increase profit for their company. If they don't, they would fall out of the top company index and be replaced with another top performer. Australia is the magic economy because the ASX has returned 11% since records started in 1979 to 2020. The Better Shares ASX index and the Vanguard Australian index are two great low-cost indexes that you can be part of, or you can choose to go with something like the Vanguard Diversified High Growth if you want some exposure to the international markets. Number two are commodities. So my definition of a commodity is anything that has a limited supply and continual increase in demand. It doesn't have to be anything traditional such as gold or silver. We've seen the rise of collectible limited edition handbags, shoes, watches. But for us 90 kids, it's really about Pokemon cards, old gaming consoles, and Harry Potter books. Last but not least, and a bit of a controversial one, is crypto. Now, I'm pretty bullish on crypto and how the blockchain would affect transactions in the future. The nature of Bitcoin and similar coins where there are limited supply basically make it similar in nature to a commodity. An increase in demand and a limited supply means that an increase in price that will protect you against whatever damage that inflation could do to your wealth. However, crypto is still a bit new to everyone, and its current valuation is driven 80% by memes and internet kids living in their parents' basements, to the other 20% being driven by massive corporations who already hold hundreds if not millions of bitcoins already. So this one comes with a big do your own research warning. Of course, there's a whole lot of other things you can also invest in, but that is really for another video. So the property market is absolutely cooked right now, and if you're out there at the moment trying to get into your first home, then all the best, because it is absolute battlefield out there. Now, my single bit of advice is, with the way that things are looking, prices are going to keep trending up. So if you find something that you like, then you have to just bite the bullet and spend that little bit extra trying to find a good deal in a hot property market does not exist. And if you're not, then invest your money wisely in one or all of the three things previously discussed, and you will cover yourself for any inflation that may stay permanent after this whole fiasco is over. I hope this video was helpful for you guys, and thank you very much for watching. I appreciate the time that you spend with me, knowing that there's probably 100 if not 1,000 other YouTubers that have been talking about the same thing. And if you like this video, please, it helps me out a lot if you hit the like and subscribe button, and leave a comment below as to anything else that you want me to talk about, whether it be real estate, investing, or personal finance. And I'll see you guys in the next video.